Welcome back to the Daily Crypto Roundup. It's Wednesday, October 29th, 2025. And the crypto market has hit the brakes after a week of relentless volatility. Prices are sliding across the board, traders are cautious ahead of the Federal Reserve's policy meeting, and analysts are split between calling this a healthy correction or the start of a liquidity crunch. Bitcoin is still holding above $111,000, but the momentum that pushed it toward 115 has clearly cooled. Ethereum has fallen just below 4,000, and across the altcoin space, everything from Solana to Cardano is showing red candles. It's the calm before the Fed storm. Before we get into today's stories, take a moment to follow the podcast and leave us that 5-star rating. It helps new listeners find the show and keeps independent crypto journalism alive. Now let's take a quick look at where the market stands right now. Bitcoin sits at around $111,251, down about 3.5% over the past day. Ethereum trades near $3,972, also down close to 4%. XRP is holding around $2.63 after a modest 1% dip, while Binance Coin is just above $1,100. Solana is trading near $195, down a little over 2%. Cardano sits around 64 cents, Dogecoin at 19 cents, and Chainlink is holding near $18. Across the board, the top coins are drifting lower in anticipation of what comes next from Washington. The total crypto market cap stands just under $3.9 trillion, with Bitcoin's dominance hovering near 58%. Traders describe the current environment as hesitant, a market caught between optimism and anxiety. Let's talk about what's really been driving the action. Over the last 24 hours, the pullback across the market has been closely tied to positioning ahead of the Federal Reserve's meeting, which concludes today. The expectation is for a 25 basis point rate cut, a small but symbolic move that would mark the first policy easing in over a year. But the bigger story isn't the number itself. It's the uncertainty around what comes next. Analysts at CryptoSlate describe the setup as a balancing act between hope and fear. If the Fed cuts rates but keeps its language cautious, risk markets might see only a small relief rally before correcting again. But if Jerome Powell hints that this is just the start of a longer easing cycle, Bitcoin could quickly regain momentum toward 120,000, maybe even 125. According to CoinDesk's Market Desk, Bitcoin has been bumping into resistance around 116,000 for several sessions, with support forming near 112. The longer it stays in that range, the stronger the breakout potential becomes. Analyst Michael van de Poppe called it a check-the-floor moment, a pause that often comes before the next leg up. But not everyone is convinced this is temporary. Sentiment data shows a surge in buy-the-dip sentiment among retail traders, and historically, that's not always a good sign. When too many people get bullish too quickly, the market often needs to shake them out. Technical analyst Ali Martinez pointed to the TD sequential indicator flashing a sell signal on Bitcoin's daily chart, warning that we could see a short-term drop before any larger rally resumes. It's a tug-of-war between caution and conviction, and you can see it playing out across the altcoins too. Solana's price has softened after weeks of strong inflows, while Ethereum's staking growth has slowed as traders unwind risk. The biggest surprise, though, is XRP, a token that's quietly showing signs of resilience amid the chaos. After a flash crash earlier this month that sent XRP plunging nearly 15% in 24 hours, many expected it to crumble. Instead, it stabilized near $2.60 and has held that level ever since. Analysts at the Crypto Basics say the token's fundamentals remain intact, with transaction volume and on-chain activity still robust. But some traders warn that if XRP fails to hold above $2.57, we could see another leg lower. One market veteran said it bluntly: XRP's story mirrors the market's story. Strong conviction on weak liquidity. It's a perfect reflection of what we're seeing across crypto. When the big money gets cautious, the smaller players have to hold the line. Meanwhile, in the background, one of Europe's biggest crypto infrastructure firms is making a bold move into the US market. Taurus, the Swiss-based digital asset platform that builds custody and settlement systems for major banks, has opened its first American office in New York City. The timing isn't accidental. With regulatory uncertainty finally easing in the US after the passage of the Clarity Act and the repeal of SAB 121, institutional interest is picking up fast. Taurus isn't a trading company. It's a builder. Its platform helps traditional banks manage tokenized assets, digital bonds, and stablecoin payments. By entering the US now, the firm is effectively betting that the next wave of adoption won't come from retail traders, but from banks themselves. As one of its founders said in a statement this morning, the future of finance isn't replacing banks, it's rebuilding them from the inside out. That's the quiet infrastructure story that often gets overshadowed by price action. While traders focus on the charts, companies like Taurus are laying the rails that will carry the next $1 trillion of digital value. When the next bull market hits, it won't just be fueled by hype. It'll be backed by real systems ready to handle it. And that's exactly why this consolidation period might be more important than people realize. Before we get deeper into the big story of the day, a quick word from our sponsor. In a world where trust is breaking faster than technology can replace it, self-custody has never mattered more. If you're serious about protecting your crypto before the next market reset, there's only one tool that should be in your setup. Ledger. It's the safest way to store your Bitcoin, Ethereum, or any digital asset offline, away from exchange risk and centralized failure. Check out the official Ledger store and protect your digital wealth before the next wave of volatility begins. Link is in the description. Now, let's get to what everyone's watching: the Federal Reserve. As we record this, the two-day FOMC meeting is wrapping up in Washington. The policy statement will drop in just a few hours, and every corner of the financial world, from Wall Street to the blockchain, is waiting for the signal. The consensus expectation is for a 25 basis point cut, bringing the target rate range down to around 4%. On the surface, that sounds bullish for risk assets. But what really matters is the tone of Powell's remarks afterward. If he hints at more cuts to come, that's fuel for Bitcoin. If he stays cautious, emphasizing inflation risk and data dependency, markets could wobble again. Several analysts have weighed in on how this could play out. Fundstrat's Tom Lee said that if Powell even uses the phrase policy normalization, Bitcoin could break through 120,000 by the end of the week. But crypto strategist Noelle Acheson warned that markets might be overconfident, saying, "The first rate cut is a symbol, but symbols don't loosen liquidity overnight." That's the key point. A lower rate doesn't automatically mean looser money. Liquidity conditions in the US are still tight. The Treasury continues to issue massive amounts of new debt, and quantitative tightening hasn't been fully reversed. That's why some traders see the recent dip as a macro positioning play. Institutions de-risking ahead of potential disappointment. Historically, crypto rallies hardest not on the first cut, but after the second or third, when confidence returns and liquidity actually starts flowing back into the system. Until then, volatility is the name of the game. It's also worth remembering that crypto markets are far more interconnected with traditional finance now than they were just a few years ago. When bond yields rise or the dollar strengthens, Bitcoin feels it instantly. The days of crypto being decoupled are over. It moves with the liquidity tide, and right now that tide is shifting fast. That's why the next 24 hours will be pivotal. If Powell confirms the cut and signals patience, we'll likely see Bitcoin test 113,000, maybe even push back toward 115. But if the tone is hawkish, expect another retest of support near 110, or even a dip into the high 100s before recovery. Either way, the real takeaway is this: the Fed is back in play, and for crypto, that changes everything. We've spent the last 18 months learning what scarcity feels like, in both supply and liquidity. The next chapter will show us what happens when that scarcity meets policy shift. Whether it sparks a melt-up or a meltdown depends on one thing: belief. The markets aren't reacting to reality anymore, they're reacting to expectations. And when you trade in expectations, perception becomes policy. Crypto has always lived in that space between narrative and math. That's why it reacts so sharply to tone, not just numbers. When the Fed blinks, Bitcoin breathes. When the Fed hesitates, Bitcoin holds its breath. So as we wait for that announcement, here's what we know. Traders are tense, analysts are split, and the next few hours could shape the rest of the year. If the Fed cuts and confirms a gradual pivot, the market will see it as validation that Bitcoin was right all along to front-run inflation. If not, it'll be another lesson in patience. Either way, this moment is bigger than a single rate move. It's a reminder that even in a world of algorithms, code, and decentralized finance, the heartbeat of the market still follows one thing, and that's human psychology. Crypto doesn't exist outside the system anymore. It is the system's mirror. And as we head into the close of this pivotal week, remember, every headline, every price move, every whisper from Washington feeds into the same equation: how much faith people have left in money itself. Drop your thoughts in the comments, follow the show, leave that 5-star rating, and as always, we will see you at the top.